Welcome to the Financial Advisors Want to Know podcast, sponsored by Dominion Enterprise Services. I'm Catherine Tindall, CPA and founder of Dominion. We're a tax and accounting firm focused exclusively on serving advisors for their own tax planning and filing needs as business owners. At Dominion, we work alongside advisory firm owners to bring proactive strategy, clarity, and confidence to their tax planning so they can focus on growing their firms. The focus of this show is to cover different areas that I've experienced as a tax planner, working with advisor clients in their lives, building their practices. So let's get started. Hello, everyone, and welcome to another episode of the Financial Advisors Want to Know podcast. I'm Catherine Tindall, one of the CPAs at Dominion. We are a specialty tax and accounting firm for the wealth management industry. And on today's episode, I have with me Chris Stanley. Chris is the founder of Beach Street Legal, which is a law practice plus compliance consultancy. And he works with entrepreneurial investment advisors and financial planners. And I've had the lovely opportunity to collaborate directly with Chris on a couple of client cases together. So I'm excited to have you on the show with me today, Chris.
Well, the sentiments are mutual. I look forward to the conversation.
Yeah. So I think, in the pre-show, we talked a little bit about the things that go on this time of year and, what's a good way to kind of kick off the year and things that advisors should be thinking about. And wanted to get your thoughts on, January is it's a little early for spring cleaning, but how do you start to get, your compliance house in order with the new year, ready for the SEC exams that, happen during the course of the year? January can be a good time to dial in on that. So let me know what are your thoughts on that in terms of things you see firms kind of getting ready to work with and, issues that you encounter?
Yeah, absolutely. I mean, whether it's planning in advance for spring cleaning or New Year's resolution, however you want to look at it, it's a good time of year to at least start to prepare for the inevitable SEC exam. Mm-hmm. I say inevitable loosely in the sense that some firms are examined every few years. We've had some firms that have gone 10 or 15 years between exams, so it's kind of hard to predict. I would say on average, we see firms examined maybe once every 9 years or so. I think statistically, that's about the average. The point being is that it's important to sort of make sure that your compliance program doesn't become stale. Mm-hmm. And the more preparatory work you can do in advance of an SEC exam, the less likely you are to be caught flat-footed, have to scramble to figure out what documents examiners are asking for, and perhaps only then realize what you don't have. Mm-hmm. So if I were to make one just overarching recommendation, it's that view the SEC exam experience as a books and records exam. At the end of the day, there is a record-keeping rule that imposes certain record-keeping obligations on advisors. That basically says you as an advisor have to keep these specific items in your files and produce those to us during the course of an exam. So even if an advisor just starts by looking at the record-keeping rule and looking at the, whatever it is, 20, 30, 40 items that are in that list and say, just run through it. Okay, do I know what this is asking for? Do I have this in my files? Do I have to rely on a third-party vendor to get this? Do I even, have this for the requisite time period, which is usually at least 5 years? So that's a great starting point, just to do an inventory to see if you have that list based on the record-keeping rule. That's a good point. From then, I would say too, just sort of running through the big rock items to make sure you're at least keeping track of the big things not to screw up. So those are things like your annual ADV amendment, making sure you're paying your registration renewal fees on time. All SEC registered advisors have to do an annual compliance review, which is more or less a retrospective to see how you may have screwed something up from the compliance perspective over the last year, and if there's any opportunities to improve. And so there's some things that I guess are just like the meat and potatoes of compliance. And if you can at least start there and incrementally build on top of that, that'll hopefully help prepare for that inevitable SEC exam.
Yeah, it's a lot. It's kind of I kind of have a similar experience on the tax side where, this time of year is if you need to be making record keeping changes in your books, or we need to be making planning changes, like January, like the first quarter of the year is a good time to get a lot of that stuff done, just because it's, the longer you wait, especially if certain things require decisions or big changes or, are going to impact and ripple into other things, like the sooner we have it on the radar, then it can just land at the right time. And then we're not, rushing at the end of the year when it's, okay, we got a month left, what are we going to do? Planning for the inevitable.
And you can correct me if I'm wrong, but I imagine in a CPA's world, from an accounting perspective, documentation is key. In other
Yeah.
words, the IRS, a state taxing authority, really isn't going to believe you unless you have demonstrable evidence to produce to them to evidence whatever you need to evidence. It's the same thing with the SEC. In other words, if it's not in writing, it never happened.
Yeah.
You can tell the SEC all day long, oh, I did this, I checked that, I performed this compliance test. I have this in my, in my memory, if you will.
Mhm.
If it's not in writing, it never happened. So
Yeah.
that's really where just the meat and potatoes, compliance policies and procedures, code of ethics, document what you're doing, showing your work. And another thing that's really low hanging fruit is frankly just to have a very basic compliance calendar or
Mhm.
compliance checklist over the course of the year that's ideally mapped to your compliance policies and procedures to say, hey, compliance manual says I should be doing X. Here's my list that I check once a month to make sure I'm actually doing X.
Yeah.
So again, I imagine in the tax world too, there's just certain milestones, certain things that ideally you would be doing over the course of the year to stay on top of things.
Yeah, I think the big takeaway that I usually have for people, especially on the tax side, and I think this is going to be true on your side as well, is that these administrative functions within a business, they should just be processes.
Yes.
It should just be like brushing your teeth. Like if you feel like you're rushing or you feel like you don't have time for these things, it comes to a bigger issue of, you don't have a good system in place to deal with it in the first place. And a lot of the times I find, especially with firm owners or, smaller firms that are maturing into larger firms, getting some of this administrative, it's like systems engineering that needs to be
Mhm.
done around who's doing what are the things that we do on a monthly basis and a quarterly basis and an annual basis, and how much of my time as the firm owner, am I going to be involved in these things versus what do I hand off to a third party person, like, a you or a me, or an internal person that's collaborating, like a bookkeeper, or, if there's a compliance officer who's somebody else. And just having that kind of mapped out and, give it the capacity, like give it the time capacity that those tasks take. And, once you've kind of built that system of the different steps that you need to take, especially on our side with the record keeping, because it's just, every transaction that comes in, it needs to be
Right.
going into an accounting system. Once you've got basically the system down of how you're doing it and the different tools that you use, and it's on the calendar, and it becomes a brushing your teeth, meat and potatoes, just routine activity, and it doesn't become a fire that you're trying to put out,
No,
um,
absolutely.
which is not
What
what
else?
you want.
No. And the other analogy that often comes to mind is like trying to change the tires on the bus while it's driving down the road, or
Yeah.
pick whatever vehicle you're of choice. But the point being is like the more you can start to get that infrastructure and that foundation underneath you from a compliance perspective, when
Yeah.
maybe things aren't as complicated, maybe as you don't have as many clients, maybe you don't have as many employees, ideally, inevitably your firm grows to a size that you're comfortable with, but you're going to get sidetracked with HR matters, hiring,
Yeah.
working with your clients, developing your business, et cetera, marketing efforts. And like compliance has a tendency to fall to the sidelines. Nobody gets into the business to deal with compliance, right?
Yeah.
So that's why it's like, okay, if you can at least set that foundation early in your
Mhm.
trajectory, all the better. And there's a lot of technology now that can really help you make this more efficient. So like when I first came into the industry, we literally had offices of file cabinets. And if somebody wanted to publish a piece of advertisement, a piece of advertising, it was a physical document.
Mm.
And, we would sign it and scan it. And like, it was a whole big thing. Now there's a lot of digital workflows, digital workflow management systems, software, some that are compliance specific, some that are not. You don't have to over engineer it, even if it's just a couple hour calendar block once
Mhm.
a month and a checklist to go through, fine. Or you can hire a very custom tailored specific compliance software to be built specifically for you. That's also fine as well. But I think the goal is to start small, incrementally build from there, and it'll make your life a lot easier down the line.
Yeah, that's such excellent advice, and it also applies, I think, to my world as well. I always tell people, as you're gonna be going through the progression of growing a practice, if you've got infrastructure issues in how you're running some of these foundational components of like compliance, record keeping, bookkeeping, tax planning, you want to get those kinds of things buttoned up so much earlier on than you would think, just because when you're running, when you go from being the $1 million firm to the $5 million firm, you don't want the problems to now have been like in
Oh yeah.
these magnitudes of issues now. and dealing with it when you're at that level. Like it's much easier to tackle a lot of these things when it's small, and then you put in the good systems. It's easy to test the systems, and then you kind of set it and forget it. And then as you get more complex over time, obviously there's changes, especially on our side when, we have things like equity changes or, as you hit certain thresholds of activity, planning techniques change. But for the most part, I think once you make that switch, especially maybe for people in the audience who are, if they haven't gone independent yet, or they're thinking about they might go independent and set themselves up, when you first kind of make that transition out of W-2 to business owner, for those that do, you walk yourself into just this layer of complexity that you're basically, at least from a tax and accounting perspective, that first dollar that goes into the self-employment up to, X amount, you're going to be in this level of complexity that's new just because you're just in a different category now.
For sure.
I had this conversation with somebody the other day where it was, I said, it's whether it's 10,000 or 100,000, it's the same number of hoops that we're going to have to jump through, So for a lot of times for different things that we do, it's okay, if you're going to introduce a new layer of complexity, like make sure that it's going to be worth it. But just realize that you're going to need infrastructure to support you. And, especially for things like the tax and accounting and the compliance, is that, when things go bad, they can go quite badly and become a really big distraction from what you're trying to achieve. But
I imagine, much like in the tax world, in the SEC compliance world, backdating documents and pretending you did something 6 months ago, a year ago is, let's just say, frowned upon. So sometimes I've had conversations with advisors that said, hey, I'm doing some catch-up work and I'm going through like last year's tasks, and can I go back and write the dates as if I completed it previously last year when I should have? And it's like, well, technically not. You should complete it now. Maybe list it as an opportunity for improvement. If it comes up during an exam, you might have to fall on the sword, but that's a much better outcome than having a situation where you have documents where you're basically falsifying them. So better to do something late than never, and certainly better to do something late than pretending you did them earlier. And so all the more reason to like just chunk it up monthly, quarterly, whatever the case may be, whatever your preferred cadence is, but don't back end load everything, because invariably what we find is whatever future timeframes an advisor has allocated to compliance is at that point taken up by a great business opportunity. A new partner they want to bring into the firm, an awesome client they want to land, a new software changeover they're going through. Like the timing's never going to be perfect. So it's like, take the small bites now, your future self will thank you.
Yeah, absolutely. And I think, at least in the tax and accounting side, you would be surprised at how much we can do retroactively. Like I'm always surprised by this. Sometimes we'll do something retroactively and it does, it's going to trigger some interest and penalties, but that's just making a business decision at that point. But I think one of the other big components of like kind of thinking through compliance systems, whether it's the tax or, the legal compliance side, is always thinking about that opportunity cost. Because a lot of times I'll see advisors where they take way too long to give up the control of some of these functions, or, figure out how to systemize it, figure out how to delegate it, et cetera. And so then it just turns into, if you look at what the opportunity cost of, how much attention you're having to put on this for the fact that, take the time to to systemize it, to delegate it, to get the right people in the right seats dealing with it, the opportunity cost can be really significant. Like I was talking to an advisor a couple months ago who did his own tax returns, and they were fine. They were competently done. But I asked him how much time he was spending.
Oh, right.
And I was like, ooh, like what's the value of your time? Because you doing your tax return, this is just trying to save a cost center versus, if you had spent all of that time prospecting, either prospecting like junior advisors that could tuck into your practice, or new clients, or mentor, something that's going to increase your exit value in the firm. Like those just became incredibly expensive tax returns.
For sure.
So
and I'll say too that like while the SEC requires all advisors to have a chief compliance officer, it doesn't require that the chief compliance officer bear the sole burden for every single administrative compliance task. So they're fully empowered to delegate responsibilities. they still ultimately have a responsibility to supervise the work that's going on. They can't simply just farm it out and forget about it. But there is not this expectation that the CCO has to own every single little process.
Yeah.
And so, to your point, availing yourselves of whether it's technology, delegation, some combination of the two, at some point, you're going to have to cross that bridge.
And so I think maybe to shift our conversation to another topic, something that we were talking a little bit in the pre-show was about, this time of year, a lot of advisors are collaborating with CPAs, in regards to their client work. And we were talking a little bit about the common practice of how to be doing compensations for third-party referrals. It's always an interesting topic on the CPA firm side, just because we have different disclosures and restrictions on like how we receive referrals. So it can be a tricky topic on our side, but at least from the advisor side, what are some of your thoughts on that? Catherine here. Just wanted to say thanks for tuning into the show and hope you've been enjoying it. Since we're all at the mercy of social media algorithms, if you wouldn't mind rating the podcast on whatever platform that you listen to, I'd really appreciate it. And also, if you're looking to stay in the loop on current tax updates, what the firm is working on, and just the things that I think you as a firm owner need to be aware of when it comes to the world of tax, you can sign up for our newsletter using the link below. I only send out editions when we have really useful things to share or things that I think are important to have your attention and energy on. So let's get back to the show, and thanks again for being a listener.
Yeah, I mean, it's probably one of the more common questions that we get, simply because advisors often have other professionals in their network, whether it's estate planning attorneys, tax professionals, maybe insurance professionals, others that are in a client's life, or maybe have their own independent businesses, and they'd love to be able to compensate those individuals for the generosity of making client introductions to the firm. And so the good news is there is a path to compensating third parties for client referrals. But as you might imagine, there are some compliance hoops to jump through. And one of the more frustrating and convoluted aspects, that is kind of question zero or question one, if you will, is let's just use a CPA in this example, does an independent CPA have an obligation to become registered as an investment advisor representative, or IAR, in order to even be qualified to receive compensation from an REA in consideration for a referral?
Yeah.
And the reason this is such a pain in the neck to deal with is because of our federal system, we have various state securities authorities that all have their own state securities acts and regulations and rules and policy positions, most of which are written, some of which are not, which is frustrating, whole other conversation. And then we also have the SEC. And the long and the short of it is, those that are interested in receiving compensation from advisors for referrals have to be aware of what regulatory structure they may be subject to. And more specifically, based on the state in which they reside or the state from which their clients are originating that they're referring, do those states impose any sort of registration, examination, and filing obligations to become an IAR? And the most common threshold is, okay, do you have to take and pass the Series 65 exam and become an IAR and associate with yourself with some registered investment advisor just to receive that compensation? Or is there a path based on certain states' rules that say, no, we don't require that registration or licensing? Or even a third option, is there the possibility for SEC federal preemption to apply and negate and moot all these state securities acts? So not to get too much into the weeds, but there's definitely a bit of an analysis that a CPA, again, for example, that wants to be compensated should be comfortable with, to make sure they're not running afoul of any sort of securities regs. So again, that's kind of step zero, step one, before going down that path.
Yeah, that makes sense. And I wonder, with some of those compensation agreements, because I'm thinking about this from the tax and accounting side, it's, does it make a material difference if it comes through as not a revenue share or something like that, or if it's just, a flat rate, or, how some of those agreements are worded in terms of what the CPA is, entitled to. I know on our side, when I've looked at these rules in the past, just being a CPA and having had this come up as a situation, we always just ended up saying, like, this was going to be too much of a too convoluted, and then also just the sharing, like, for most of the work that we've ended up doing, that it's usually a two-way street.
Mhm.
So, but I think, on the advisor side, I wonder, like, have you experienced that where it can make, pretty significant difference in the way that some of those agreements are worded, or if there just is no agreement and it's a, hey, we'll send you, we're not under an obligation to send you a formal, referral fee, but we do anyway, kind of a thing. And what are some of the, I guess, instances you've seen of this?
Yeah, so I would say to the first comment about compensation structure, mostly it doesn't matter.
Mm-hmm.
You can't talk to an attorney and have him or her not say it depends, but it depends. So that's my plug for today. But it really legitimately does, because most states require those that receive comp to be registered as an IAR. There's a subset that more or less say, if you're receiving any sort of compensation for client referrals, whether it's asset-based, revenue share, flat fee per lead, whatever the case may be, it's like broadly construed. And then there's some states that say, well, there's going to be potentially carve outs, either depending on the form of compensation or depending on what type of what type of professional you are. Don't quote me on this, anybody in the listening audience, but I think Georgia may still have on the books a specific nuance for CPAs. Like if a CPA is a referral to an advisor, there may be some nuances there. So point being is, like, this becomes a very state specific analysis, but generally speaking, if it's any sort of compensation that's getting paid to the referral source, it's going to trigger this analysis. Insofar as the documentation or having an agreement in place, at least with respect to SEC registered advisors, it's sort of black and white that you have to have a written agreement in place if you're going to be paying a third party referral source more than de minimis compensation.
Okay.
And at the other end of the spectrum, it's like, okay, if we're just friends and you may send us some clients and we may send you like a gift basket just for general our good naturedness, maybe we can squeak through. But if it's really a quid pro quo type of arrangement, or it looks and smells and feels like a compensated referral arrangement, walks like a duck, quacks like a duck type of thing, it's really going to be hard to carve yourself out of it. Because at the end of the day, I mean, regulators care about what a relationship actually is in practice, not what it's memorialized to be in writing.
Yeah. Absolutely. No, that makes total sense. And it's something that I've actually encountered a couple of times, not on the referral side, but actually in succession planning, where basically we had a senior advisor was partners with some other advisors. Senior advisor passed, spouse inherited their ownership stake. And then it became a question of, well, the spouse isn't licensed. So how are they actually going to be, can they even own this? Can they even get revenue, income from this? Because they're, just a layperson. They don't have any licensing or anything. So I've had that come up in that direction a couple of times too, which is always kind of interesting to see those cases come up.
Yeah, I mean, it's impossible to predict all the unique fact patterns that I'm sure we encounter, and there's inevitable gray areas. We'll inevitably have to look at rules and regs, guidance, and make reasonable conclusions based on what we have to work with. And that certainly can be an area that like creates a bit of a, okay, let's make sure we cross the T's and dot the I's and not put the surviving spouse in any sort of hot water. And one would hope that a regulator would not like turn the screws too hard here, obviously, given the circumstances. So there is some helpful like practicality that can be brought to bear. But yes, this is unfortunately one of those very fact-specific gray areas. But I mean, in a quote unquote traditional referral relationship, again, with the CPA, there is very specific requirements in the SEC's marketing rule, for example. They did away with their solicitor rule. They collapsed it in concept into the marketing rule to more or less say, hey, you have to have a written agreement with a referral source. You have to transparently disclose to the referred client whether the referral source is a client or non-client, whether compensation is going to be paid, whether there's conflicts of interest. And actually, you have to describe to the referred client the terms of the compensation. So you really can't hide behind getting into the specifics of the dollars and cents there, which some advisors are caught off guard by. Then there's also some expectation that referral sources are not ineligible persons that are subject to certain SEC convictions or bars or court convictions and things along those lines. So
Mhm.
there's a few hoops to jump through, a few compliance odds and ends, a few ADV updates, things along those lines. It's a navigable path, but it's definitely not something where you want to start paying somebody for referrals and then try to reverse engineer compliance thereafter, because sometimes you
Yeah.
might have put yourself in a tough situation.
Yeah, and from the tax and accounting side on those, another kind of gotcha thing that I've seen come up a couple times is, you know, even if you're working with like a CPA firm, um, if they, if you're paying them significant compensation, you still want to get them a W-9 form from them so
Oh,
that
yep.
you've got their ID number, and then also see how they're being taxed. Because if they're a partnership, then you should be issuing them a 1099 at the end of the year for the
Mm,
comp that you give them. So
gotcha.
that's another little like gotcha thing, which
Mhm.
it just, yeah, it never ends with this stuff.
I know. You're preaching to the choir. Tell me. Tell me about it.
It's like I get fatigued by it, and it's like all we do. I think maybe just for one last little thing for us to kind of go through, maybe not little, but
Yeah.
to see what we can cover with this is talking about some of the preparation needs for the SEC recent amendments to the regs SP.
Mhm.
And kind of some of the things you've been seeing there with some of those changes for firms.
Yeah, and there's a lot of meat on the bone here, so I'll try to keep the audience awake and stick to the Cliff Notes version. But the long and the short of it is like Regulation SP or Reg SP is a body of law that applies to SEC registered advisors and deals with the privacy and protection of client information and specifically client sensitive information. And it
Mhm.
governs how advisors must protect information, share information. It also is the body of law that covers the requirement for advisors to send privacy notices to clients with potential opt-out requirements. It also governs how advisors have to dispose of client information when they're getting rid of their records or when a client terminates. Those have been on the books for years, but what's new is the obligation now to have an incident response program, a data breach response program, if you will. There's now a prescriptive requirement to notify clients in the
Mm.
event that you've had a data breach, for lack of a better term, really within a specific period of time. And then there's also this new requirement specifically with respect to service providers, where if a service provider has access to your client information or possesses it or deals in it or again stores it in their systems, they too now have an obligation to notify you as the advisor within 72
Mhm.
hours if they become aware or reasonably believe that there's been a data breach incident affecting your clients.
Mhm.
So not only now is there an expectation for advisors to have an incident response program, policies and procedures, they must provide specific client notification within 30 days of becoming aware of an incident. There's also now this sort of indirect impact on service providers as well, and the prescriptive requirements for them to notify advisors. So it's kind of a big deal because this really hasn't existed, at least at the federal level historically.
Mm.
Data breach notification requirements have historically been kind of a patchwork of state laws, and the Reg SP doesn't supersede any of that. So now again, we have the juxtaposition of like various state regs with a federal overlay. What fun! But now at least there is that federal standard that advisors can look to as at least a baseline for how they
Mhm.
have to protect info, what they have to do if it's compromised, who and when they have to notify, and also service provider oversight and the notification they have to provide.
Mhm. Yeah, uh, those are all good points, and it's interesting too. I imagine this probably impacts. I think an area that I'd be pretty concerned with, at least on the tax side, like for firms that do outsourced, where they have tax returns being done by somebody else, but it's like kind of under their service model. I have some
Yep.
firms that have been like that where, they'll basically pay the CPA firm to do, returns for clients, but it's really, the client doesn't pay for it. It just comes under the service agreement at the
Mhm.
firm level. And I know as if you're working with a CPA firm, which that's not everybody, I think in a lot of these agreements, it's usually like an individual preparer, like self-employed
Sure.
preparer a lot of the time, where you do have from the IRS requirements to be data security requirements, but they're probably the notification requirements are probably not as robust That's what the
Yeah.
SEC is.
Well,
Uh,
and historically, the SEC wasn't either, right? It was, again, more state specific. And now it's much more prescriptive with that 30-day turnaround time. I mean, this also sort of is maybe a reminder to advisors like, gosh, maybe I should do an inventory of what vendors even have access to my client information,
yeah.
what client information is shared with whom. Do we have anything in our files from a due diligence perspective? When's the last time we've checked to make sure our security features for accessing this data are configured correctly? Are we availing ourselves of multi-factor authentication?
Hmm.
Has one of our vendors had a data incident within the last couple of years? So it's a good reminder to like dust off the location of client data, get a handle on it, and then maybe some vendors can be trimmed off the list because it's unneeded. Maybe there can be more controls put in place, but at least it's going to be a policies and procedures exercise to make sure that you're prepared to respond appropriately to a data security incident, because this will invariably come up in the course of an exam.
Hmm.
And the other thing I'll mention too is it's also a good reminder to potentially explore whether it's worth getting cybersecurity insurance.
Hmm.
So hopefully advisors have at least considered E&O insurance. Sometimes they'll have a separate cyber policy. Sometimes there'll be a rider for cybersecurity, but it may not be a bad idea to look into that if advisors haven't. If for no other reason, then those policies can often afford resources to the advisor in the event they've experienced a data breach, and they can bring in both technological and legal experts to help triage and respond and assess an incident that the advisor may otherwise maybe ill-equipped to handle him or herself.
Yeah, no, that's a great point because I know a lot a lot of the firms that we talk to. That's in my initial intake process, asking them like what policy coverages they have and
Mhm.
things like that. Because I had a number of clients this year who had to tap into their E&O policies from like trade errors and things like that. And
Sure.
I imagine that the magnitudes of problem can can get a lot higher when it's a data breach. Depending on if you have identity theft or things like that that happen off of it. But yeah, so
Right.
I guess to kind of put a bow on the conversation, any areas that you feel like we didn't hit enough detail, or any like final thoughts that you want to share with those listening?
I mean, I think the one thing I'll maybe part with or leave audience members with is we obviously have a relatively new chair at the SEC, just came in last year. There's
Mhm.
been a lot of proposed rules that were proposed under the prior SEC leadership that have been since rescinded. I'm very curious to see where the SEC is going to go as far as new regs or regulations or how they're going to sort of police things. But for whatever it's worth, they're still examining firms. They're still holding them to high standards.
Mhm.
Sometimes we hear like, oh, we don't have to try as hard, or they're going to go softer on this, and that just hasn't been the case. And I don't know why that rumor has sort of started. The
Yeah.
point being is like they're still examining with all the veracity that they have historically. And what I will say is that, for those advisors that are concerned with the potential possibility of transitioning from SEC to state registration, stay tuned on that front. We really haven't heard anything definitive. The SEC talked about raising the threshold to even be eligible for SEC registration.
Mhm.
Nothing has really happened on that front in material terms. So that's one thing to look out for in the future. But yeah, it just, never a dull moment as we talked about in the pre-call as far as compliance to dos and tax to dos.
Yeah, no, and for those running firms, it's not a profit center for you. So it's, you want to get it managed, get it functional, and then go out and do what you love to do and not be
Mhm.
having to have your finger in every pie with some of this stuff. But so for those of you that are, for those listening that are interested in learning more about the work you do, Chris, can you talk a little bit about Beach Street and, how you guys work with clients and how they can get to know better kind of some of the work that you do and things that you put out?
Absolutely. Yeah. So we're either a law firm that happens to be a compliance consultancy or a compliance consultancy that happens to be a law firm, six of one, half dozen of the other. But the bottom line is we focus purely on REAs, the investment advisory and financial planning community. We try to offer both legal and compliance solutions. BeachStreetLegal.com is our website if you want to learn more about how we do work with clients and our typical client base. Based here in St. Louis with a few other compliance professionals and attorneys scattered around in other states. And very much appreciate the opportunity to have the conversation today.
Yeah, thank you so much for coming on. And for those of you listening, I always say send me a DM if something stuck out because I'm always trying to find, the things that advisors get the most value out of sometimes in these conversations. I'm surprised. It's not the things that I was expecting.
Yeah.
So for those of you listening, always feel welcome to reach out and tell me what you thought of the episode. And we'll also post nearby wherever you're encountering this, how to get in touch with Beach Street. We'll put the links nearby so you can learn more about what Chris and his team are doing. And I know, from the engagements that we've worked together, it's been really great getting to work together. So thanks for coming on the show today, Chris.
Thank you so much. Thanks everyone on the line.
Thanks for listening to the Financial Advisors Want to Know podcast, again, sponsored by Dominion Enterprise Services. If you found this episode valuable, I would love to personally hear from you. Connect with me on LinkedIn and send me a message. I'm always interested in your feedback, future episode ideas, or questions you'd like to see covered in a future episode of the show. And be sure to subscribe to our monthly tax update newsletter, where we share timely tax insights and planning considerations specifically crafted for advisory firm owners and what we share to our own clients. We'll see you next time.